Good afternoon, everyone. This is Tim Picciott with the Liberty Podcast. Gotta go check what day it is. It is April 30th, 2018. And what I want to talk about today is some of the fake news regarding the different economic numbers that are out there. And also, some of the big developments that I see happening in both, the bond market, how that's going to affect the stock market, how it's going to affect basically your money, how it's going to affect your retirement investing, all very, very important stuff. But the first thing I want to bring your attention to is an article. Actually, it's September 30th, 2015, where Donald Trump says the unemployment rate may be 42%. And I actually kid you not. And so, one of the things that, let me go, right now I'm actually reading a PolitiFact. I mean, again, I trust these guys, as far as I could throw them right now. I may have a torn labrum, so I can't throw anybody very far at all, is the bottom line. But this is a quote from Trump where he says, Trump described an unemployment rate in the range of 5 as, quote, such a phony number. That's from September 28th, 2015. He then goes on to say the number isn't reflective, he said. I've seen numbers of 24%. I actually saw a number of 42% unemployment. Can you believe that? No, I'm just trying to posture in how he would say that. 42%, he continued. 5.3% unemployment. That is the biggest joke there is in this country. The unemployment rate is probably 20%. But I will tell you, you have some great economists that I will tell you it's 30, 32, and the highest I've heard of is 42%. Now, I sort of buy the 20 numbers that he was mentioning. I do know where he gets that stuff. And right before the election occurred, I wrote a book, a little pamphlet. It's like 18 pages. I could have made it longer, but why make it longer when you can get out all the information you need to get in as little words as possible? So it's a 18-page pamphlet. If you guys want it, just send me an email at info@thelibertyadvisor with an O.com. I'll make sure to get that out to you guys. Again, info@thelibertyadvisor.com, and just put in the subject line how it's rigged, and I'll be sure to get that to you guys. You can also go to thelibertyadvisor.com. There's a blog section. Then one section is called How It's Rigged, and I've got them broken down by category, and I should be looking at them right now in front of me, but I don't. And so, the crux, and I know where they're getting these numbers from. It's not entirely sure on the 42% number, although I did just find a little bit more information on that number. But if you go to the unemployment rate, and they've really changed over the years, how they calculate these numbers. And so you've got, what the government uses is called U3, which is going to be the narrowest definition of unemployment. But then once you've been unemployed for a certain amount of weeks, then you're not counted as unemployed anymore. So you could actually have more people unemployed, but have the unemployment rate go down. So, riddle me that. And Donald Trump knows this, and he knows how this works. And so that's why it's very frustrating, seeing him talk the talk as a candidate. And the only reason I'm bringing this up is a lot of people have told me, like, hey, Tim, you've really changed. You were on Team Trump. You were on the Trump train. What's going on? I see you criticizing him, and you've really changed. And really, I haven't changed at all. I've been saying the same stuff the entire time. And it's Trump that's changed on many different things. And I know why he's doing it. I know where he gets these numbers from. So when it comes to the unemployment rate, these are phony numbers. He was correct calling these numbers a joke. And so even the government's own broader definition shows, the rate probably about 7-8%. And then if you use shadow stats, so if you go to shadowstats.com, it's showing the number probably closer to like 21-22%. Now, where he got the 42%, and I didn't even know this until today, is he referenced David Stockman, who I think is a pretty reputable source. Although, really, I think what David Stockman did in this, I don't know if this is entirely accurate. It probably is closer to like that 20% number. But, he took the amount of Americans there are who could potentially be in the labor force, and he multiplied that by the amount of hours that they would have then worked versus the amount of hours from the Bureau of Labor Statistics that were actually worked. So there was a potential of 420 billion potential working hours, but there was only 240 billion working hours recorded by the Bureau of Labor Statistics, or BLS. And so that's where you get the 42.9% number. And again, this is stuff that's coming straight out of Donald Trump's mouth, stuff that was basically coming out of my mouth. I wrote a little book on it. And so it's very, disheartening seeing him use all these, phony, baloney numbers. Now, the other calculation that I showed how it was rigged was the inflation rate. Again, these are just like the super quick boil downs. If you want to get, the more in-depth boiled down or the more in-depth answer on all this, you can go check out my blog at thelibertyadvisor.com. There's a section called How It's Rigged. Everything is right there. Or shoot me an email, and I'll send the entire booklet to you guys free of charge. So what we have here is the government has changed their methodology throughout the years. If you look at 1980s, how they calculated inflation versus today, it would be close to, we're having around 10% inflation, whereas the government, came out the other day and said, actually one source said it was, I think, 2.4%. And then, of course, the number that the government used was 2% because, and this was one form of government said it was, one branch said it was 2.4, another branch said it was 2. So then the government, in terms of how they calculate GDP, decided to use the 2% number because that number fit their narrative better. Now, if you look at how they calculated inflation back in the 80s, again, because they changed things around, well, then now it would be 6% today, again, versus, the 2% number that we're seeing right now. And again, I do have, this is just the Cliff Notes. I mean, they do all sorts of things. Like they, used to be, let's say, wealthier and you used to buy steaks and now you're not as wealthy, so you buy hot dogs. Well, now they substitute the price of hot dogs versus the steak. And that's only just the beginning of what these people do. And there's things like chain CPI and all sorts of other crap that they do. But how this relates to the recent GDP number, so the GDP number that came out, and I'm not looking at this right now, but I believe it was 2.4%. But one of the important things to understand with that number, and actually let me just pause this for a second while I pull this up. All right, so I'm on the Bureau of Economic Analysis website, BEA.gov, and it's showing that the Q1 GDP increased at 2.3% for the first quarter. And see, in the fourth quarter, real GDP was 2.9%. So we went from 2.9 to 2.3. And just to put this in perspective, Trump said that his new campaign slogan for 2020 is going to be, keep America great. Well, the last 3 years, and again, everyone who's listening to this right now knows, or if you don't, you can go back and see stuff that I wrote before this. But, I've never been a fan of Obama. I'm not one to, try to make him look any better. But, just trying to be honest, though, the last 3 years of Obama, the GDP grew at 2.3%. So now the GDP for Q1 is 2.3%. So, and then over the last 5 years of Obama, it was 2.16%. And now it's 2.3%. So how is, let's even give the benefit of the doubt, 2.16. How is that, a failure of an economy, but 2.3 is like so great, so outstanding that, stop the presses, GDP's never been better. I mean, it's just, you see all these ridiculous things that, and again, I'm a political atheist. I don't care about any of these political parties. I think they're all liars. I think they're all snakes. And, I did support the president quite a bit, went on my way to, make sure he defeated Hillary, but, I'm not going to, just carry the water for him no matter what. Unlike Larry Kudlow, who is his new chief economic advisor, who, one of the very first, I think, TV shows that I listed because I'm weird. And, when I was 18 on Facebook is I wrote that I watched the Kudlow Report. It's something that I was watching when I was, I think, like 14 years old on CNBC. So that's where I said I was weird because I was watching this stuff when I was really little. And, Larry Kudlow, he's the guy who thinks a lot like me, but he's also a team player. And so, he's going to basically carry the water for Trump and, go against things that he said in the past because now he's part of the administration. Well, guess what? I'm not on anyone's payroll. I'm not part of the administration. I'm just trying to give the truth of what's going on. But that 2.3% number could have actually been even a little bit worse because what they did is they rigged that number a little bit. So the current dollar GDP increased 4.3%. And now, there's some estimates of, this is, again, it's on the Bureau of Economic Analysis website, where it's some estimates right here where I'm trying to find it, but there was something where it showed that, the inflation rate was closer to 2.5%. Okay, right here. The price index for GDP purchases increased 2.8% compared to an increase of 2.5%. So they used 2.8% as like their inflation number that they were referencing, but the actual number that was used when they calculated it was 2%. So if you take the current dollar GDP increase of 4.3%, you subtract 2, which is the stated inflation, then that's where you get the 2.3% growth rate. Now, if you use some of the other numbers that we used before, through, let's say, shadow stats, when we went back to the inflation data, if we go back to, a 6%, if the economy grew in real terms at 4.3, but the inflation was 6, it means that they actually lost 1.7%. And if it was closer to 10 and it grew at 4.3, that means that it would have been down, 5.7% negative. And that is why people are getting poor, is because we understate what the true inflation rate really is. And so all of the cost of living adjustments, raises, everything's really kind of based off inflation. And so if you understate what inflation is, you're gradually going to make people poorer and poorer. And that's, exactly what has been going on. So it's just disheartening seeing, the president kind of espousing some of these, what I would call fake news. And really, for anyone that's getting mad at me for talking about the president this way, I mean, this was literally the president's own, he said this was that the unemployment rate being at 5% is such a phony number. And now he's touting how great the unemployment number is. And so you could have a situation where there's actually less, let's say, blacks or Hispanics employed, but since they've been unemployed for so long, they don't count as being unemployed anymore. And so, what that number, what they're referencing is going to be called the labor force participation rate. And so for people who are watching this right now, I'm actually, Googling this in real time. So, this is, off the cuff, and we're looking at, right now it's about 63%. So, it shows that there's, quite a good deal of people who aren't in the labor force right now. So you've only got 63% of people who could be working are working. And so, again, these are numbers that Trump as a candidate would talk about, but then now that he's the president, he's got to use everything to his advantage to really kind of paint the picture as rosy as possible to, really fit his narrative, because now he is a politician. Now, with that said, anything that happens in the economy is not necessarily going to be the fault of Donald Trump. What his fault is taking all the credit for everything, because now he's obviously going to get the blame, and he probably would have got the blame anyways, but I wish he would just level up with the people and tell them what's actually going on, because if you want to drain the swamp is the Federal Reserve System. It's a system that you can never get out from underneath because it is high-tech slavery. If you owe interest on all the money that's ever been created, and the interest is the debt, so to speak, is larger than the amount of money that's been created, you're always going to, there's no way to ever get out from underneath the situation. And what has been going on the past 30 years is you've got interest rates that are going down, down, down. I'm looking at this on a chart right now. Let me back out. So from, 1981 to today, for the most part, they were going down. Well, I guess, there was, a little blip where it went back up. So from 1984 onwards, it was pretty much a straight march down. Or I guess, they went back up again, and, because of the crash of, October of 87. So, really, from about the time I've been born, or, really depending on how you look at this, or a few years back, interest rates have been going down. When rates go down, the underlying value of bonds go up. So you had $1 million, you're in a 10-year bond, rates go down 1%, now you've got $1.1 million. And the reason for that is if you could, let's say, get 12% for a bond, and now you can get 11%, if you sell your 12% bond and you can only get 11 in the market, well, people will pay more for a bond that pays 12% versus one that pays 11. Now, the opposite happens when rates start to go up. So when rates start to go up, you have a 10-year bond, $1 million, rates go up 1%. Well, technically, it's duration, not bond, but that's a concept that I don't want to get into the weeds of right now because none of you care. And if you do care, email me. Again, info@thelibertyadvisor.com. I'd be glad to go into greater detail with this. But what you can do is, your $1 million, rates go up 1%, is now 900,000. Rates go up 2%, now it's 780,000. You're the Federal Reserve and you're sitting on $4.4 trillion of bonds. Rates go up 1%. Now you've just lost $440 billion. What has been troubling that's been going on recently is that you've got the Federal Reserve has actually been selling their bonds. Now, this is a position that I can't even believe we even got to this point where they're actually able to fool people long enough to get to the point where they actually could sell bonds. So what I'm trying to find right now, okay, here we've got it pulled up. This is the monthly asset purchases by central banks. And what you see in this chart, for those of you who are watching, for those of you listening, I'm going to narrate this, is you see, from 2009 on, it was close to, $100 billion a month in new purchases. Then we got close to 125. And this is worldwide, but mainly led by the Fed. And then we've got, 2013, it's probably inching up closer to 150, 160, 170 billion-ish. And then 2014, the Federal Reserve, essentially, I'm trying to find the line. Yeah, so right here, this pink fuchsia line is the Federal Reserve. They stopped their program. And so what you see right here, this is the Bank of Japan. So as soon as the Fed stops their program, Bank of Japan ramps theirs up to make up for the slack. And then this other purplish line right here is the Europeans who started their program out of the blue. So what you can see is that even though the Federal Reserve stopped buying bonds around late 2014, the amount of monthly purchases by central banks dramatically went up. So it went from about $90 billion a month in central bank asset purchases all the way, to, the Fed stops their program 2 or 3 months later. You're looking at 140 billion, give or take. Again, I'm eyeballing this right now. And then you fast forward a year and we're just underneath $200 billion. And this actually isn't even taking into account the Swiss National Bank, who owns about $80,000 US of just, or 80,000 of just U.S. stocks for every family of 4 over there. And so, I know I've talked about this in the past, how they're, taking money out of thin air, printing it up or with their keyboards, and then just using that to then buy stocks. Now, again, this has nothing to do with Donald Trump. These are much, much bigger than Donald Trump. And so you take a look at the S&P 500 versus the total assets at the Federal Reserve, which are going to be in blue, S&P in red. And, I thought things would start going down around 2014 when this program leveled off right around Halloween. But, it really didn't, the stock market really didn't go anywhere for quite a while. So pretty much right before right around the time Trump was elected, then it really shot off. But it was under the backdrop of having all these other central banks around the world printing tons and tons and hundreds of billions of dollars every single month. And again, that's a program that is going to be quickly coming to an end. And now not only are the banks, the Federal Reserve, not buying bonds, but now they're actually starting to sell bonds. I believe it's about $30 billion a month they're selling. Part of it's treasury bonds, part of it's mortgage-backed securities. But then the interesting part of this, or maybe it's not interesting to you guys, I don't know. But then what is going on is that by, I think it's October, that number is going to get closer to $50 billion a month, which is going to max out at $50 billion a month. And this is also under the backdrop of, you've got the president took a deficit from $666 billion, which was Obama's last deficit. So go figure that Obama leaves a deficit of 666. But now we're running close to $100 billion a month deficit, or a little over $100 billion a month. And so you've got the Federal Reserve needing to sell 30 billion. Soon it will be 50 billion. Then you've got the Treasury having to sell 100 billion. And what that is doing is putting tremendous amount of pressure on the 10-year Treasury rate. And so right now, we're looking at the Federal Reserve balance sheet. Looks like it tops out at $4.452 trillion. And again, let me see what time frame this is. So this is December 13th, 2017. It looks like was the peak. And then now we're sitting at, let's see, $4.37 trillion. So we barely have shrunk this at all. And what we've seen is that the interest rates have completely shot up. So I'm trying to find my chart with the interest rates on here. And of course, I got a little pop-up ad that decided it would be a great time to pop up at this point. Thank you, Bloomberg website. Let's find. So one of these was the 10-year Treasury. Here we go. All right, so the 10-year Treasury has been inching up quite a bit. And so when Trump was elected, let me try to just back it up for a shorter time frame here. So when Trump was, at one point, we got down all the way to, looks like 1.38, maybe even a little bit lower than that. And then right around the time of the election, so let's see, November 2017, just bear with me just a second here. Actually, it's right where it shoots up. So November 1st, 1.83. Again, this would be the week before the election, or the week of the election technically. And then you go, 2 weeks later, it's 2.36. So a gigantic move. And now it actually did cross 3. It's showing actually a read of 3 right now. So it's, right around that time frame. It's weird. It's exactly 3 to down to the T on this. So, and again, today, might be a little bit above it, might be a little bit below it. Doesn't really matter. But the trajectory is up. And that's off a tiny amount of bonds that have actually been sold. So traditionally, who would go and buy our bonds? Well, who would go and buy our bonds were the Chinese. We basically have told them to go take a hike. And what they've also done is now they've got this petro yuan system that is basically designed to be a backup to the, or an alternative really to the petrodollar. So I wrote an article on this on Steemit about a month ago called China Officially Launches Petro Yuan, which is a gold-backed yuan oil contract. So one of the main reasons America has been able to maintain its dominance is because there's been an artificial demand for dollars, because other countries, in order to buy oil, they've got to first, take their local currency, put it into or they have to convert it into dollars and use those dollars and then buy oil on a national level. Well, there's another player in the game, and that player is called China. And so, do you think the Chinese are going to be, going through their own market, or do you think they're going to be going through, the dollar-denominated petrodollar? Of course, they're going to be going through their own, and it's also going to be backed by gold as well. Although, a little bit more details kind of remain to be seen about what that actually means. But it's a way to have a backup system. So when America, tries waving its big stick around and says, hey, Russia, we're banning you from the SWIFT system, which is basically the main kind of financial system that runs through New York and London. We're going to ban you, basically cuts you off. We're going to cut you off, and then we say it to Iran and we say it to all these other countries. Well, they're going to say, okay, well, fine. We didn't want to be a part of it anyways, and now we're going to go with China, and you can't really, accuse us of, doing anything, malicious to, try to bypass the petrodollar if you kicked us off the petrodollar to begin with. So this is a major, major development that's really been, I think really completely ignored by the mainstream. But, the bigger point is that our government cannot afford higher interest rates at all. We've got, the debt is, the interest rates almost doubled since Trump has been in office. Now, if you go back to June, let's see, at one point, so July 6, 2016, it was 1.38. Now it's 3. Now, and again, that's under the backdrop of barely being able to sell any bonds whatsoever. So, what's going to happen when, the Federal Reserve has to, the only way we're going to be able to entice people to get these, start buying bonds again is to raise the rates. And so if China's not going to buy them, if Japan, who has a debt to GDP of 200%, the most indebted place basically in the world, even more so than like Venezuela, which actually has less debt as a percentage than America does, just they don't have a petrodollar. So, it just paints a very bad picture because there's really only two kind of scenarios that happen. One is that the Federal Reserve needs to reverse course, start buying bonds again to lower this, which that has its own set of circumstances and how that plays out from an investment standpoint. Or, they, try to hold the line and say, okay, we're going to let the market sets rates. And then basically the government would be paying, $1 trillion a year in interest at some point in the very near future. I'd say certainly at some point in the next 10 years, they'll be paying over $1 trillion unless they, again, like I just mentioned, start buying bonds and lower the rate back down to zero, at which point there is no interest because we're buying all the bonds. But at that point, no one will have any faith in the money and, the stock market will go through the roof. But the average American doesn't have any money in the stock market. So it's just, these are questions that I've posed to, some of the best minds out there. I've posed to, anytime I run across, billion-dollar fund managers, I ask them this stuff. Guys like Doug Casey, who's a big-time investment guy, I've asked him this personally. I've asked, Jeff Berwick this. I've asked Ernest Hancock, all sorts of Peter Schiff, all sorts of people I've really posed this question to. And really, I think they all sort of agree with me. Except for like the big investment guys who are, that manage billions of dollars. They don't even know about this stuff. And they seem like they're pretty concerned when I tell them, but, they don't want to upset the apple cart, so they're not going to really look into it that much. But they do respect what I'm saying. Now, why this poses a problem is because, the people who are diehard Trump supporters, which, at one point I was, pretty diehard until he changed his tune on a few things. And I'm not rooting against him. I think I do want him to do well. I do want him to drain the swamp. But the biggest swamp out there is the Federal Reserve. It is a swamp you can't build an economy on a centrally planned, dictated, top-down Federal Reserve system where you've got this, board of governors who makes up every decision on interest rates, who game things, who rig things, and all of it really isn't to the benefit of, anybody unless you're worth, a couple of $1 billion, and maybe at that point it's going to be worth it, and somebody like me, I benefit from what they do because it makes the value of these assets go up. Well, their program is completely reversing. At one point they were buying lots of bonds, and now they're starting to sell bonds. And so if the point of buying bonds was to raise prices, then wouldn't doing the opposite lower prices? And I don't think that's too far of a stretch to really make that assumption. And then, everything basically is always okay until the day that it's not okay. I think that's, a true maxim with everything. And we saw that, a few months ago with the volatility index, which just measures, how volatile the stock market is, where that was one of the big Wall Street, safe things, sure things is, let's be short volatility. And then, there's, that wasn't the only thing. And so I'm going to do right now is I'm going to play a clip from January 25th, which is actually the day before the stock market high. I think it might actually be, unless the Federal Reserve reverses course or there's other central banks that start printing more money. I actually think that that might actually be the high. But let's, whether it is or not, not a huge deal. But I'm going to play a quick clip from that. Said, we're thinking about not buying any more debt. So in Wall Street terms, is when you're saying it's a hold, that means it's a sell.
Selling, yeah.
And so, that's quite an amazing thing that's going on. And also, while the rates are going up, it is supposed to be good, supposedly for the dollar. And what we've seen is the dollar has gone down, more at the beginning of this year than it has, basically since I was 11 months old. So, it's been over 30 years since the last time the dollar started off a year this week. And last year, the dollar was down roughly, I'm not looking at any notes here, but it was down roughly 10%. And so we're continuing this. And a lot of people are saying that, when the rates go up, or, Wall Street guys say, when the rates go up, well, then that means that there should be more demand for U.S. dollars. And so you have the dollar going down with the same backdrop of, basically negative interest rates all around the world, extremely low interest rates all around the world, and people still don't want to hold on to the dollar. And so it's the same situation that you're talking about with home prices going down with the backdrop of being at, whatever it was, 19-year lows, as I think you mentioned. So it's So it's the same deal. And then this is going to have trickle down everywhere. And another thing that was in that article that was particularly amazing to me is that you've got, what's his name, Jerome Powell, talking about unloading their short volatility position. So I don't know if he means that the Fed was actually buying VIX, which is the volatility index that just measures how much basically the stock market goes up and down. And so why?
Yeah. This is a derivative. The VIX is just your side bet on what the weather's going to be. What the hell is the Fed doing in that?
I mean, if you ask me what are the two worst investments you could have long term, I would probably say short the VIX and long-term treasury bonds. Now, look at what the Federal Reserve has. Supposedly, they're short the VIX, and they have long-term treasury bonds. I mean, it's like they're the worst-run hedge fund in the world, except they have such clout with $4.4 trillion that their clout then distorts everything else. So a lot of the things that, guys like myself and Peter Schiff have been talking about and yourself have been talking about for a while that are going to happen, a lot of the reason why it's been delayed is because they're in there with their trillions of dollars effing everything up and distorting things. And that's probably one of the reasons why you should try to subscribe to this podcast, because, there is a lot of prescient information, at least in my opinion. I mean, it's coming from me, so I've got to pump it up a little bit. But, this was taken the day before the stock market high so far. And you go back and, look 2 weeks later, and these funds that were short the VIX, a lot of them are down, 86%, 90%. I mean, there's ones that people lost all their money. And this was, everything's all good until the day it's not good. That could have happened, any one of the previous, days of the past 2 years, but it didn't. One day it's fine, and then one day it blows up. And so, that's exactly what I think is going to happen to everything else. Hey Tim, you might sound like a stop clock in some of this stuff, and you've been talking about Federal Reserve and all this central bank stuff for quite a while, and yeah, I have, and I know that because I'm studying the Austrian economics, because I understand, because I actually get this stuff, that one day it's going to be fine, and then one day the market's going to go down 2,500 points, the next day it's going to go down 2,000 points, the next day it might rally 5,500 points. The next day it might go down another 1,000, and then it's going to be Friday, and the market's going to be down, 8,000 points, and then the Fed's going to have to come and step in. Now they don't have to step in, but the willpower. I mean, they don't have. Ben Bernanke, the former Federal Reserve chairman, 2 chairmans ago, labeled his book "Courage to Act." Well, the courage would be to not act, to let all these bad players, to let the banks, everybody go bankrupt, and then to actually rebuild a new economy without a Federal Reserve in there who are screwing things up. And so, it's for the people who say, I don't know what I'm talking about, or I've been saying this for a long time. I was saying this whole thing with the VIX for a long time, and then one day, you look, one day, you're riding high, and then the next day you lost 90%. And now, maybe some of the retort people could say about that is, well, you talk about crypto too, and crypto, that's down 50%. Well, and I do want to respond to that, because right now the total market cap of crypto is a little over $400 billion. And so right now I'm on coinmarketcap.com. I have no affiliation at all with this website. I just think it's a good website to go to. So I think the first time that I actually, talked about Bitcoin and again, I was in such a gray area with my job that, I wasn't really allowed to say this stuff. But going back to June, I did a Facebook Live where I was talking about Ethereum. And so, in June, the market cap was a little over, depending on what day it was, it started June, a little under $100 billion. And then, I thought in August is when I had this idea to do this company. Again, we're looking at under $200 billion, about $140 billion. Then you go to, November, go to, let's say, October, again, still under Halloween, still under $200 billion. That's when I met Kirk from Innovative Advisory Group, and one of the people that could really help launch this. And then so that's when I started working basically full time on getting this out. And then there was a month where things went stupid from basically Thanksgiving to Christmas. The high was actually, it looks like the high was January 6th, so actually right around my birthday time. And we're looking at $791 million market cap. But if you really back out that 1 month, I mean, it's just 1 month things went really, really stupid real quick. Where it went from December, we started off at $333 billion, and then basically ended the month, up to $819 billion. I guess it was technically about 40 days later, and then it crashed back down to $291 billion. But now we're looking at it, and it's closer to almost $500 billion, $430 billion. But, people are like, oh, you talked about Bitcoin and crypto. And again, I'm a big fan of the crypto market. The crypto market as a whole, I think it's going to a multi-trillion-dollar market. I'm willing to put that out there on the record. And what I also do is I have a video that is about 10 minutes long stating why a financial advisor would quit his job to recommend Bitcoin, where I get into the weeds of, where I see this going in terms of not like making predictions of it's going to be worth this or worth that, but really from the standpoint of how it's going to change the world, why it's going to change the world, why somebody like me would risk everything in order to promote this. And, there's no other financial advisors when the market cap was $100 billion was out there touting this. And, I'm sorry that, someone that may have listened to me back then would have only, gone up 400%. But, if you bought in at the exact market top, then you would have lost money. Or you bought it from basically December to beginning of January, you would have lost money. But, they only lost money, and it probably would be a good idea to sell and then claim the loss and then use that buy back in to offset a future gain. Again, talk to your CPA for any of those types of maneuvers, or give myself a call. But I do think this market as a whole does have legs and still is going places. It's not saying and you shouldn't put everything into all eggs in one basket, obviously. But again, I only bring that up because some people are saying, oh, hey, you're talking about this VIX going down 90%. Well, hey, crypto could go down 90%. Well, I'm not saying people should take all their money and put it into cryptocurrencies. Is a strong point that I want to make. People should have financial plans. They should understand how much money they can afford to lose. And again, they should actually have a plan to know how much money they need to save or how much money they can spend. Because there's that classic saying, I'm trying to remember off the top of my head, but those who plan to fail can plan on failing. I think that's something like that. Anyways, maybe I'm not all with it today. But, the other thing that I really wanted to talk about real quickly was, it was actually the midterms coming up. So, if we have Donald Trump, because what you have is, and a lot of people think there's going to be this huge blue wave coming, or that's what the media is talking about. And I actually think that they are onto something, that they are correct. And believe me, I don't want this to happen. A lot of my passion is trying to prevent this from happening, but I'm not going to go, bust my, to, make sure a bunch of Republicans get in there. If the Republicans are going to spend, considerably more money than even the Democrats, they're going to pass the largest budget ever at $1.3 trillion. They're going to take Obama's deficit from $666 billion. And yes, some increases were built into the cake because of interest rates and things like that, but not doubling it, not going from 600 billion to 1.2 trillion. Not all of it is related to interest rates. So Republicans need to take some sort of responsibility for that. And when you've got the Republicans who are spending more money than Democrats, and who the optics on this are going to be terrible for them to say hey, elect us and we're going to get rid of Obamacare. Oh wait, that didn't happen. Oh wait, hey, elect us and we're going to decrease government spending. Oh wait, that didn't happen. Oh wait, elect us and we're going to do all these other things we said we're going to do. Well, they have done some of it, but I think not nearly to the extent of running everything that we'd expect them to be able to do. And I think that they're going to be hurting big time in the elections. Now, one of the elections people used to kind of refute the blue wave analysis was out here in Arizona. I actually live in the district. I live in Peoria, Arizona, which was congressional district number 8. the one where Debbie Lesko won over the Democrat. Well, the Democrat was a nobody who no one even knew her name till 2 months before, a doctor who came out of the complete blue, who had basically no help from the Democratic Party whatsoever, because this is a district where basically it's been completely Republican run since the time I was born. I mean, a lot of times Democrats don't even challenge because there's such a stronghold of conservatism in here. I think in the past, recently, the Republicans won by as much as 30 points. When Trump was there, I think they won by 25 points, and now they just squeaked out a 5-point victory in a place where Tim Picciott lives, who obviously moved to a conservative place, to a place where where there's a ton of independents, but a lot of people are independent because they think the Republicans are a bunch of rhinos. They think the Republicans, are basically the Democratic Party light, and so this is a very conservative area, and you only squeak out a 5% gain here. It's not going to bode well for the places where Trump only won by 5,000 votes here, 50,000 votes in this state, or so I do see that being a big problem. And if you thought that the Republicans were completely basically useless when they controlled everything, well, how do you think it's going to look like when all of a sudden now if the Democrats end up taking over? And then if the Democrats end up taking over the midterms, what do you think that's going to do to the economy? What do you think that's going to do to gridlock? And again, I don't even care about gridlock because most of the time everything they do ends up being bad anyways. So fine, have them do nothing for all I care. But that's not the point. The point is, I think the stock market is going to view that as very bad news. I think obviously at that point spending is not going to go down. I mean, that's going to be pretty obvious at that point. But who knows? I doubt we'll be in official recession by the time midterms roll around. But by the time 2020 rolls around, we might very well be. And the reason why we won't be in an official recession is they do things like I just mentioned, how they rig these numbers. So if they say inflation's, but let's say inflation, might really be 10 or 11, and they can't hide it, and they've got to say it's 3.5, and we're only growing at 3, but we got 3.5% inflation that we can't hide. Then at that point we'd be losing 0.5%. And so if we accurately counted in this stuff right now, we probably would have never even technically even gotten out of a recession from how they, and a lot of that has to do with how they count the inflation data, and a lot of it, and then look at how much GDP goes to, bombing people. So, okay, are we really better off because people are spending more money on oil? Are we better off because people are spending more money on healthcare? Are we really better off because people are spending more money on, student loans? Are we better off that people are spending more money on mortgages and interest rates? Are we really better off because, we're spreading, bombs all around the world? I would argue that we're actually not, but all those are positive contributors to GDP. And one thing I didn't even mention before is you also have an inventory buildup, aka people aren't buying stuff. And so the inventory buildup would have a negative effect to the GDP, although how they calculate it, they don't actually take that into consideration. But what it really is doing is we borrowed a better number, 2.3 being a better number from the future by doing some rigging. So I would actually think that this is not going to be great news. The Democrats, I think. I think there is a lot that they can run on, at least from a congressional standpoint, and when that happens, certainly the interest rates are not going to go down at that point. There's not going to be any, all of a sudden more demand for U.S. debt. There's not going to be, the optics of, the debt's going down. At least it was going down underneath Obama from the deficit. And now all of a sudden, the Republicans get in, the deficit doubles in 1 year. I mean, while we're collecting record amounts of taxes, might I add. So yeah, I do believe that cutting taxes does increase the GDP, but you have to also have the balls to then cut government spending. And right now the government, they do not have the balls to cut government spending, and they actually increase government spending. So if you increase the amount of spending while temporarily decreasing the amount of money you bring in, it's a very easy optics to say, hey, we had Bill Clinton in there, things are going great. Then we have George Bush in there, he screws everything up. So then Obama had to spend all this money and to fix their mistake from the Republican, and now we elect Republicans again, and they give corporate tax breaks to the ultra wealthy. And again, I'm just saying these are the optics that are going to be out there. Some of the stuff, when the tax breaks, I don't even think there even should be an income tax. I think it should be based off consumption tax. I don't think this was actually tax reform, although I think it's better that the number is getting closer to zero. If I was to do it myself, I would have done it a little bit differently. Hopefully this didn't just turn off because I went to a screensaver. All right, looks like we're back on now. But there's all these bad optics, and really it's not going to bode well for the GDP. But the bottom line is everything we're talking about right now today, everything I'm talking about, it has effects on you. It has effects on your money. It has effects on your portfolio. It has effects on your retirement. So shoot me a line at info@thelibertyadvisor.com. That's advisor with an O. And if you want to talk more about how this can affect your retirement, because again, if you're 5 years away from retirement, there's one way to play it. If you're super conservative, there might be another way to play it. If you're 25 years old, there's another way to play this. If you're interested in getting cryptocurrencies in your IRA, also, I'm probably the only person around, to my knowledge, that can actually have real cryptos in your IRA and have traditional investments as well. So, there's a whole host of reasons. We have protected growth strategies where we're buying basically insurance on the downside through options to limit the maximum drawdown while also giving you almost all the upside. Because at the end of the day, people want to know that they're going to avoid the major market downturns while also participating in the upside. I think depending on how this shakes out, certain asset classes will do better than others, and the time to prepare is right now. We were lucky that everything didn't crash, I guess, in 2014, if you're listening to this now and didn't do enough to, or haven't done anything to protect yourself, because now you do have a chance. This chance, I don't know how long it's going to be, just like, with the VIX. That could have happened a year and a half ago, but it didn't. It happened the first week of February. And so right now you've gotten lucky. You're listening to this, so you're lucky that you're listening to somebody that knows what's going on. Not to say that I can guarantee anything, but give us a call, shoot us an email. You can go to libertyadvisor.com, thelibertyadvisor.com. I've got a blog that I'm trying to rework right now. I've got a website guy I've slammed him with a whole bunch of stuff, and so it's not the finished product that I ultimately want it to be. But I will have a section on politics. I don't know why I said it that way. It sounds kind of weird. I'll have a section on crypto, have a section on the market, have a section on investing, have a section specifically for millennials. And so if you listen to this and say, hey, I don't like your political stuff, well then I'll have stuff that's categorized for all the other topics. Or you want to listen to me for crypto, well, you'll be able to do it just for that. Or you want to listen to me just for market information, well, you'll be able to do that. I mean, today was a little bit of a grab bag where I touched on a little bit of all this stuff, but really, again, I was, a huge, and I still support the president when he's doing things that are good. I think the North Korea stuff is great. I think he is doing a lot of really great stuff. So don't take this as, one huge, Donald Trump bash, but, when he is saying things that are completely counter to what he was saying as a candidate, and people are giving him cover for that, I'm not going to give you cover for that, because I am actually standing by my conviction, the same conviction that basically, has resulted in me being unemployed right now until, because I was standing on conviction of actually believing in blockchain, believing in crypto, believing that this is a better future, and it's actually a future that is going to be taken off because the genie's out of the bottle. And so I was willing to do that hard sacrifice. You think, poking a little, holes in some of the stuff he's saying, like that's going to be a big deal to me? Of course it's not. So, I'm just trying to give you guys the truth. I hope you guys, really appreciate everyone that's watching this, everyone that's listening to this. Please share it. Please tell your friends about it. Odds are they're not getting this information from CNBC. Well, I think the odds of that are about 100% that they're not getting this information from CNBC, unless like a Peter Schiff or a David Stockman maybe slip in every now and then. But definitely appreciate the watch, to listen. You guys can follow me on Steemit. I'm at Tim Picciott, Picciott. Thank you all for watching and listening, and hope you have a great rest of your week. Take care.